What's going on, guys? Brisk here, and today we're going to be going over a brand new topic in Yahoo Finance. Today's video will cover everything related to the balance sheet for equities within Yahoo Finance. So, essentially, the best way to go about doing this is go to the right-hand side of your screen and look up the equity in question. For simplicity purposes, we're going to look up Apple. So once you click over on the equity that you want, you're going to go over to your financials section. Once you click on the financials section, you'll pull up the income statement. You can see the breakdown of your total revenue less your expenses to come up with your net income. That's essentially the overarching understanding of what an income statement is. There's many types of revenues, many types of expenses that we'll get into in a little bit, but you can also show the balance sheet. Now, the balance sheet is a nice breakdown of the company's assets, liabilities, and stockholders' equity. Now, all three of these things are very essential to understanding how a company operates and what its profitability looks like. Profitability is equatable to your net income, how many assets you have on hand less your liabilities. All of these things definitely matter in terms of analyzing a company. Now, you can go over to your cash flow to see plenty of different items within. What you can see is your operating, investing, and financing cash flow. Everything essentially amalgamates to your free cash flow. So let's go back to the income statement and we can search on a quarterly basis to see how the company's doing. So if you're looking at the total revenue of Apple on a quarterly basis, you can see that the first quarter, which ended on 3/31/21, was mid-level profitable for Apple. You can say that total revenues hasn't exceeded what it did in 2020. However, you can still say that it's on its way to producing the revenues that it needs. You also have sections under your revenue, your cost of revenue. How much did it cost for you to actually make that much money? Now, this value less this value will give you this value. That's your gross profit. Essentially, the cost of revenue is another way of saying what's your cost of goods sold. So here's their total revenue, like aka what they made from all of their sales and stuff like that. Here's your cost of goods sold, and in order to get your margin or how much you made based on how much you sold, you get these two numbers subtracted to get this number over here. Now, there's plenty of other caveats, also have your expenses on a quarterly basis, on a monthly basis, and on a daily basis as well. So based on this, here is your operating expense. Your operating expenses can be categorized into administrative expenses and R&D expenses. You would imagine that Apple would invest a whole lot in research and development and administrative expenses just to make sure that they're keeping up with the entire market. So based on that, you can take your gross profit less your operating expenses, so you get your operating income. This is the cost of actually operating, right? Then you can add some other things to your operating income. Your operating income can be added to by your interest. That is essentially what they get from your non-operating expenses. Let's say they have like a contract with an individual or an entity that gives them extraneous income. So you take the difference between these two numbers to get this number. That's your net non-operating expense. Then in your other income expenses, this is something that you have to subtract from the total value. Add this value over here to this value, subtract this value to get this value. Now, your tax provision is something that you have to pay as a company. You need to understand what your tax bracket is in order to actually be able to sell your products at a reasonable rate. So what you have to do on your income statement is take your 28 mil from your net that we just calculated over here, subtract your tax provision, and you get your net income stockholders equity. That's how much you can actually net, right? That's your net income. And based on that, you can get your earnings per share. Essentially, you can take your net income, which will be your value right here, divided by your basic average shares, and you'll get your basic earnings per share. Because your earnings goes hand in hand with your net income, and your diluted EPS goes hand in hand with your diluted net income. It's not that much of a difference, but at the end of the day, it kind of does matter. So that's essentially your earnings per share. Your operating income as reported will be right here. You can compare that value to what you calculated right here. That's what was calculated based on their financial metrics. This is what they did internally. Obviously, you would imagine that they'd go through immense auditing to make sure that these numbers are accurate. Here are your total expenses calculated from all of the things above, your normalized income, your interest income. So now let's get into this topic over here of EBIT and EBITDA. EBIT is your earnings before interest and taxes. EBITDA is your earnings before interest, taxes, depreciation, and amortization. What are all of those things? Let's go into it. EBITDA is, like I said before, your earnings before your interest, taxes, taxes, depreciation, and amortization. Now, your EBITDA is seeing what your revenue is, finding your gross profit. Remember, I mentioned your cost of goods sold. You can find and equate that value to cost of revenue. It's just another interchangeable word. Now, going back to your EBITDA, you're going to see that depreciation also accounts for your earnings before tax. Essentially, depreciation is how much is your equipment on hand losing value over time. Your SG&A is part of your operating expenses. Then you're also going to find that your interest is going to be something that's on there as well. Your interest expenses, all that good stuff. So you'll find your tax and you'll get your net earnings. So essentially, EBITDA is going to be your earnings before all of this stuff that's highlighted. So you're going to take your gross profit, subtract your SG&A, and essentially all you get after that point is your EBITDA. Let's go through and calculate exactly what their EBITDA is. What you can do is you can subtract your SG&A and research and development expenses as well. May not be part of income and taxation. That is EBIT, that's EBITDA. Let's go right into the balance sheet. The balance sheet is the breakdown of total assets, liabilities, and stockholders' equity. Under total assets, you can see your current assets, which can be broken down into your cash and your cash equivalents. Anything along those lines, your receivables, how much you're bringing into your company. You can get other receivables as well. I mean, it's not directly related to products. Your inventory on hand definitely relates right back to your total assets. Your total non-current assets also includes like your buildings, your plant, how much investment you actually have in your company. That's all part of your assets. Let's go ahead and look at our liabilities. Your liabilities include but are not limited to your current liabilities, to your accounts payable and accrued expenses. How much do you owe another person? What's your current debt and capital less obligation? Essentially what that is like how much do you owe currently to people? What are your deferred liabilities? That will include your current revenues as well. So anything that's deferred, it's something that you're not accepting until the payment comes in. Therefore, somebody has to bear the burden of that. The non-current liabilities also take into account plant. Your long-term is going to be your debt and capital. So for non-current liabilities, we're going to go into long-term debt and capital. Long-term debts is going to be how much do you owe over time that may be factored into your liabilities. Current deferred liabilities also include your taxable income. Also, you can go into your common stock equity. You can see this entire part of the balance sheet. Now, let's do a general formula here, all right? I'm going to open up Excel. Assets equals liabilities plus stockholders' equity. Under your assets, there are a whole range of different things that you can have there, right? You can have anything including or not limited to your current assets, your long-term assets, cash on hand, inventory, if I can spell. Inventory, let's go back and just get a nice categorization of all of this. Inventory, definitely your cash and receivables. Anything like accounts receivable will definitely be an asset. So I'm just going to abbreviate AR as accounts receivable, anything receivable. Your liabilities are going to be related to your current debt, long-term debt. See what else we got. Liabilities. We've got your non-current liabilities, your current liabilities. That's essentially everything that's related to that. In your stockholders' equity, you can find your common stock equity, the amount of shares that you have, how many shares were issued. This is essentially how many shares are issued by Apple. Any given year, you can see that they're declining over time. So that can lead you to understand that either they're declining the amount of open interest that they want within their company, or they just want to sell some shares. So I don't want to give away too much of Apple's investment strategy here. That's essentially what it comes down to. Your stockholders' equity is going to be your common stock, retained earnings in here. Yeah, so all those other good things, that definitely matters in understanding exactly what your company is doing. You can see your cash flow as well. And, this is just something that is going to take a whole lot of time to understand. It's not just going to be something that you get right off the bat. I mean, if you do, you're in a better spot than I am. But the thing with all of this is that it definitely takes time to understand the financials of a company. You're not able to understand the financials of a company that you're investing in, then there's probably no reason that you should be investing in them in the first place, because it really matters. It really, really matters to understand how the company is doing on a book level, how the company is doing on an environmental level, how the company is doing just overall in the market even. So it definitely pays to know all that stuff, and that's what I'm here for. So with all that being said, I'm so happy that you guys decided to stick around for this very, very lengthy video. If you guys like this video, don't forget to like, subscribe if you're new. I'll see you guys next time. Brisk out.